I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight, we'll talk about this amazing rally after the downward reversal on Wednesday, and we'll get into what's going on in the markets and how we're likely to end the week. Let's get into the video. Okay, folks, quite the day, huh? We were up over 2% at one stage. That was quite amazing. I have to say, Daniel, you're always first. Anyway, good job, man. Crazy day today, to say the least, huh? Talk about the Stampede trade. This was it. I think I sensed a lot of short covering. I think a lot of people had this market wrong and not looking for higher prices. And I'm going to have to commend and think that all the work that I've done over the years, when we have this database that has been leading us into this bullish, maintain the bullishness throughout the year. We've had a couple soft spots, but continues to just suggest that we're going to see higher prices. We're still getting traction on the short-term database. It's absolutely amazing to me. And this has been the case all year long. I did notice the NASDAQ has taken the lead again, up 20% on the year. S&P up 19.8. S&P's been leading by just a little bit. Of course, I think a 3.7% boost in Apple probably didn't help a little bit there. Russell up 11, still lagging. Still, I'll cover the Russell tonight. And I'm going to try to get through fairly quick, and just so it's late, I know. Appreciate a lot of folks hanging out. We'll see what kind of viewership we get, but typically late at night I've been getting a lot of folks to hang out, so that's good. Just the best I can do right now, folks. At least I'm showing up, and that will make 4 videos this week. Okay, I'm not going to be doing anything on Sundays. It's just not convenient any longer. So most likely what we'll see is Monday night through Thursday. So. Couple things that I was looking at here. We're just seeing this crazy scenario around the interest rates. Remember, they dropped interest rates yesterday, but guess what? That 10-year went up, right? Well, I'll cover that as well. It's very interesting how, it's the old story of, buy the rumor, sell the fact. Otherwise, you play it strong, except for today we had that outside reversal going yesterday. Immediately when I wrote the Substack last night, it was obvious that trade was never going to happen. We opened, I think, above the R1, R2 level last night. And a couple things that we'll talk about is we did get STX sell signals. Title of this video for tonight is, can the market rally continue? And I'm questioning that we still have, I'm going to show you something. It's not a perfect one, but we do have on a short-term level, the forecast is that Friday will be the final part of this rally, and then we're probably going to see some pullbacks. And that's most likely what's going to happen. And I'll go through all the details here in a minute. But, I kind of went on a little bit of a rant, so bear with me a little bit. It's still kind of in my head when I was writing the Substack last night. Just looking at, I was really appalled. I talked about it a little bit in the live stream yesterday, and just to make sure I'm doing every precaution, I've rebooted the computer, so I've got a clean slate with very minimal running, so we don't have any crashes on this live stream. But it was interesting because I'm frustrated in that Jay Powell did not acknowledge that all of these 818,000 jobs that were overstated, that somehow that didn't affect the GDP calculations. Just about almost every calculation that has to do with the economy. Also, that employment number is important. Nobody adjusted anything. And I think it's really amazing. there's so much I want to say, but if I say what I want to say is will get me off of YouTube. So I'm not going to say it. Okay. But I will tell you that I think that it is appalling that we've seen just about every government agency has been corrupted at some stage. We'll just leave it at that. And that we're seeing a lot of bogus numbers come. But here's the deal, and I've talked about this over the past several weeks, is if the market participants, the folks pulling a trigger on, putting the mouse up here and pulling the trigger and buying and selling things, if they're going to respond to these numbers, we have to pay attention. And the good news is there are no numbers tomorrow. There's no economic releases at all tomorrow. So we're running on sentiment, whatever that is. And, so I think we're probably pretty close to the market starting to roll back a little bit. We did see, and somebody mentioned FDX, and I think that is a sign. FedEx had a missed by a big way here earlier, and that should have some pressure. Yeah, I'm just reading a couple of comments here. Yeah, everything needs to be adjusted, but nobody's going to adjust it because it's not convenient. It messes with the dialogue. So one of the things that I mentioned in Substack last night is maybe things are way worse. They said that the employment had slowed down. It actually was just slightly below what was really should have been reported, right? I think they were reporting like 220 or 250. I'm going off the top of my head, jobs, and really they were more like 140, and now we're 111. And you have to ask the question: are those even valid? I'm going with a couple things here that when we look at employment numbers and stuff like that, I'm going to lean hard toward the ADP numbers. I'm going to, we saw the continuing claims come in right in line again. They seem to be very stable. I'm looking hard through all these reports, and at some stage here, I will come up with something, maybe a list of reports that can be trusted more than others, and that will be the key, I think, from that standpoint. Yeah, yeah, and Floyd, you're right about that. There's other factors in these numbers that are coming out, but at least the week to week numbers, they're getting adjusted. I'm just looking. I'm grabbing in the dark here, trying to find numbers that maybe we can trust that give us more of a realistic view of what's going on in the economy. But from the standpoint of what we saw today, like I said, I just sensed a lot of desperation in the trading. Especially, it started in London last night. I was up late. Matter of fact, I was up later than I wanted to because the first probably hour of London trading, which is midnight my time to about 1 in the morning, I just was sitting here in amazement watching this market rally, and it was just like they just piled in. I suspect there were a lot of folks that wanted to play. I was sitting here going, I see exactly what they're doing. They want to run yesterday's high number. If you recall, we traded all the way down to 56.91, and the high yesterday, I believe, was 57 going off memory here. But the point is that I knew they were going to try to run those numbers. Once they got through that, we ran 20 handles through that. It was 75. Then, of course, as we went through yesterday, we got up to, I'm just looking at the number here, at 57.97.50. That's a crazy number. Now we're trading, I'm looking at multiple screens here. We're trading 69.75, so we're about 30 handles off of yesterday's high. A bit of a rejection. We got an RTX sell signal. I'll go through all the details. But I mentioned in just when I first started talking here, is we're still seeing traction come into the database. It's fascinating. Now, I'll go through, this is the plan for tonight. I'll go through the WaveTech database, and then we'll go in through the indices. We'll go through S&P. I'll bring up the Russell because I think it's worth looking at because it's the only index that's not making new highs from the previous August highs. So let's go ahead and let's just start with the database here. So as I look at the database, bear with me just one second while I refresh this page. So here we are, 70, got to get to the right, this is the daily. And this is the tonight's run that happened. So we're looking right now at 71.01. I'm just going to do these numbers in my head, about 1,620 new entries and 239 exits. So definitely positive again. We're at 71. I told you we get 68, 72. It's about maxed out. But the fact that it's maxed out doesn't mean it's overbought. There's not really a component where overbought, oversold comes in here. We have to go to the metrics on the side, this position overview, and we're looking at the duration right now at 18. We're right now percent fulfilled at 48%, about halfway through the cycle of the short-term database. So that means it's about 40 trading days. So that's the better part of 2 months. So we've got a potential, another month at least carry us into mid-October for just this cycle. It doesn't mean it has to happen that way, but it does look to me that there's still forward-looking returns that are likely to come from here. The interesting thing is the current average profit is 3%, and the average typical of just these short-term models about 11% on average when you normalize all the database. And you have to realize we've got 14,989 symbols in this database, and that includes all the stocks, which are probably about 6,800 roughly. The rest are ETFs, mutual funds, they can be bond funds, all that stuff together. But we have a material part of this. 7 out of 10 of these symbols, no matter what they are actually long right now. So on a short-term basis, and it's even more on an intermediate. Let me just bring that up while we're talking about it. Is the intermediate is at 76%, so 7.5 out of 10. So almost everything is long right now, which is interesting. We're printing all-time new highs, all that stuff. And let me go to these stats back over to the stats here. And what I want to show you is on the weekly optimize, we typically have the duration right now is 128. The typical is about 200 days, which is very close, just under 1 year on average on the optimized model. And then we're looking at right now, the current average profit is, bear with me a second here, 11.89. The average profit is 30%. So there's a lot potential in this database yet. So this seems like a broken record. I started off, it goes back just a year ago now. When we came into October, if you recall, we started to see a lot of traction on the database. That's where this thing all started. So we're 1 year into the cycle. Typically, we get between 220 and 250 trading days. But what we've seen this year is very unique, and is that we've seen, I think, 3 rotations where we came down into right around 61%, back to 70, back to 61. Now we're pressing it into the extremes again. So maybe this is the final rotation, yet to be seen. But when we look forward, there's still a ton. There's 20% on the intermediates if we play out the entire cycle. It doesn't have to, but these are really good measurements. And this is what led me to talk about last year, when we came into January. This is why I was talking about this is going to carry us at least into July or August. And then as we got through the year, now we got into September, October. This is, maybe with the Fed's action yesterday, maybe this is going to just boost this thing another shot here, because obviously the lower yields, or the sense of lower yields, is setting things up for optimism right now. But it's kind of we'll say short term kind of dangerous from the standpoint of just breaking out. But I went through a lot of details last night. We'll go ahead. Let's just go ahead and get into some of the numbers here and go to the S&P. And this is we're still seeing. I mentioned. Let me bring this up so you can see it. This right here is the daily chart. And you see we closed above the market grid, although market grid is like in this sharp upward channel. But you can see all of a sudden we've been seeing higher prices being forecasted every day. Now we're seeing flatten, maybe a little bounce, but most likely what we're going to do is at some stage come back and test this 10-day moving average. It's a simple average. We should come back to that. And the algos are, this is where I was showing you where this is at right now. So let me just bring this up so we can draw in a couple things here. So this is a potential inverted V top right here. I just drew in. We don't have a big inversion going on here. There's a little bit of mixture. What's really good is when we get these things to show up and where I can draw a line straight through these and all of them line up perfectly. So you get the inverted V's all down or the V bottoms. Those are really strong signals on the PPM. So when that happens, it's pretty powerful. So we have one. All that suggests is it looks like over the course of the next, we'll say, let me just get the number here. Let's not guess. So it's projecting by next Thursday, we're going to see a cross of the first derivative. That tells us that we should come down and test that moving average. It is rising right now. The moving average is rising at the moment at about 35 handles per day. So that's at currently at 56.33. So in 3 days, it'll be 57.20. It'll be pretty much where, just a little bit below where we're trading right now. So we should start to see some retracement, I would think, after tomorrow. And with the RTX sell signal, it suggests 1 to 2 sessions sideways. Sometimes we'll get these RTX sell signals and they'll mark a more significant top. And this, let me just bring up one more thing here before I move on. I've been talking about these fib targets, and these are very valid fib targets at 59. You'll see them over on the far right, 59.43, 61.50, and 62.83. These are all valid numbers, but it's going to take a bit for this to actually get up and to reach these levels. But I think we'll see the 59 handle here over the next maybe 5 to 8 days, maybe a little bit of a pullback, and then but the forecast is really flattening out sideways into the moving average. Coming out here, once you get out where my cursor is, it starts to get, it's a little fuzzy from that standpoint. I don't know. I see somebody talking about Elliott wave guys. I'm an Elliott wave guy. I don't see a wave. Maybe, I don't know if this would be wave 2, but I still think there's a potential that we're in a corrective phase in a broader range here. Let's just go and take a look at that. Let's go to a weekly chart real quick, and then we'll move on and get through here. So weekly is starting to look like we're going to accelerate all the way. This is amazing. We're not seeing any big rollover on an intermediate level until first week of October. So we've got another 2.5, 3 weeks positive range. And then what we see after that, look, as we come into the election, we're just looking at somewhat of a cliff or a big loss of momentum. And I think at some stage, I've been arguing that I didn't think the market would get ahead of itself here with the election coming up, but it's still safe, I guess, to go ahead and trade this thing up higher from that standpoint. So let's go ahead and let's move on. Let's go to NASDAQ. I'll stay on a weekly chart for a second here. So you can see the NASDAQ is also going in this flat mode. We're not, we haven't made a new high on the NASDAQ yet. We have these fib targets up here. I've talked about them in the Substack. Right now, 21,221 is fib target 1. That really just puts us up at retesting the highs. But I think ultimately, I'm going to draw in some things here. I think this NASDAQ pattern is significant. I think really what we've got working here, I'll just draw this in. This is kind of the extreme levels. I think what we've got here is probably more of this before we break out, and we'll find out which way which way is it going to go out of this pattern. I suspect, looking at the longer term charts, as we come into the 1st of October, I'll do my long-term forecast that I usually do every beginning of the month. But anyway, that's the pattern I think happened. I think this is going to be the dominant pattern as we go forward. Take a quick look at the daily here. So daily also has some fib targets going on. The shortest fib target that we have right now is for 21,014. Like I said, that puts us right at the, let's see what the all-time high was. All-time high was 20,983. So this first fib target, if we hit, would be a slightly new high. And I think if we go there, especially if we went there in this cycle, that you're just going to get rejected. But the one thing that I would point to is that the patterns that are set up here are, you can see here's that same little V top, but this right here, we've got upward slopes coming in, and this is what is telling me that we're likely to stay above the 10 moving average. We should continue to climb higher in this pattern, and ultimately we probably get here, which really is, like I said, this is just a test of this high over here. That's what we're getting here. That's okay. There's still a trade here, but I don't think we've got the big breakout coming, at least on the daily and the weekly. It doesn't look that way. The one positive thing, just like I said, we look at the WaveTech database. We've got forward-looking, another 20% on average on those stocks that we have long. We have 71%. So we're looking at 10,000 signals coming in. Yeah, foreign economic professors all say that the numbers are bogus. Yeah, they are, and they usually are and always have been. There's always questions, and like I said, it's pretty easy to see these reports that come in that are bogus because they'll have seasonal adjustments. They're just playing with the numbers, and it's very convenient for everything from monetary policy to elections to build the narrative of what folks, what they want us to think. Let's face it, this is, and the thing is, and this is my argument, just back to the data points again, is that this is what they continue to do, is they want us to focus on certain things. And I mentioned also in last night's Substack, I'm grateful that I'm a technician. I'm grateful that I have this massive database that is driving me. I'm okay with going along with what's going on here, but I've had the opportunity to have this database and use it for decades now, almost 3 decades. And I'm trying to think what year. It's 4 more years from now. The actual WaveTech database will have been around for 30 years, which is amazing that that thing's been around that long. So here we go. From here, let's go to Russell. and then I'll just fly through the rest of the stuff, and we'll try it about we'll try to summarize what we should see coming into Friday. So. Okay, so this is, I think, an interesting pattern, and I've talked about this before. This was a monster distribution top that we saw right here. We had a little mini here, and then question is, it looks like we're setting up for something else here where we're looking at the algorithms are suggesting that, we're pretty close to, just really setting some kind of pattern. And my argument has been for a while is that we're just locked in this range. And even though the front end of the curve is finally starting to drop with the Fed is taking the foot off the pedal, so to speak, I notice that, they're still doing QT, they're still selling securities. That's going to boost, let's face it, there's a little self-fulfilling here as they put this out with lower rates. Is that going to bid their portfolio a little bit so they can sell better? We'll see what happens here. But my concern with the Russell has been just this. I just think there's way too much, stock ahead. There's a lot of bad companies here. I think we talked a little bit on the live stream, I think before we crashed, about MDY, how the mid caps have a little better profile from a financial standpoint. They probably have, and they're have a little bit better pattern set there. All right, let's go ahead and I thought this was interesting since we're getting yields to really just rocket. Look at what's being forecasted for, and I've been talking about this, where we're going to see probably 385, 395 in the 10-year. And you're like, wait a minute, Bob, they just announced they're lowering rates. Well, this is what I've been talking about. As it normalizes, you're going to see the front end of the curve come down, the back end of the curve is going to stabilize to be right up higher. Ultimately, we probably see the front end of the yield curve, the Fed funds all the way up to 2-year down in the 3.5, 3.2 range, and the back end pretty much where it is right now. You're going to see 3.7, maybe up around 4%, and we get this nice little slope. You get 1.5 points, typical spread above Fed funds over to the 10-year or the 30. You're really looking at right there, that's 4.25 rate from just looking at it from that standpoint. Those are my expectations. That normalization won't happen until next year, probably third quarter of next year. Just want to see if I think I have this drawn in. Let me just see. I'm just bringing up something on the screen here to see if I think I have. Let me just see something here. Yeah, so I have this. We've now got this front end of the curve down here at 4 3/4. Let me draw in something here. I'll use this chart too. So now this line here is everything's going to start coming down and normalizing. And then what we're seeing here is we're going to see this thing go. So this is 3.5. I've been telling you that this is how the yield curve is going to look. It's going to just be more of this slope. So we're going from this inverted to this level. And my argument has been for a while, everybody has been hung up on this inverted yield curve. And there's still a lot of folks screaming about the inverted yield curve, that it's the longest one ever and all that. But it was longest whatever, not because of market conditions. Previous situations that happened weren't introduced by the Fed raising rates on the front end. They were market driven. And those are more valid when you have a tightness in the front end of the market, not an artificial tightness. Just like when we saw the interest rates down at 0.5%, we shouldn't have been there. I was arguing back in those days, if you were listening to me, that we should be 2.5%, not at 1/2 or zero. And so the Fed is forcing these things to move around here. I'm just looking to see if I have what if I've got, yeah, so this is the forecast, and I put this up the other day, is that the red dots here are being forecasted into Q3 25. This yellow line here is a 3.5% rate, and this is around Q3 25. I think, and I know some folks are saying, Bob, how did you get it so wrong when I was screaming for a 25 basis point move? I did say that it was justified to do a 0.5% based on what happened in the back end of the curve, because it was down about 50+% of basis points. But I didn't think they would go to that level that they did, especially before the election. And they went there. And so that's okay. This does disrupt a lot of things. I can tell you a lot of trading desks at banks were quite busy and will be busy throughout this week and early next week adjusting some of the portfolio. Maybe some of them already had pre-bets or at least had things covered up. And as I keep arguing, everybody that's posting these unrealized losses in the banks, nothing in the bank is not covered. Everything's hedged for the most part. There's very little open liability on most of this stuff. And so even if it's hedged not directly with derivatives, there's other types of ways to diversify a bank portfolio. I spent 9 years plus working with banks and on their liability side. So it's just how it works. So you have to understand the banking system. It's not really at risk, although I can tell you this set the tone for a lot of folks depending on how they were positioned. And almost everything is open outright spreads, even steepener spreads or flattening spreads. And I suspect everybody had a steepener on, so it went pretty good. So let me look at a couple of comments here while we're going through. Yeah, Christoph, you're right. Good to see you on here. I am not in the recession around the corner camp. The reason why is I think the structure is going to come into play, and I just don't see the stressors in there that are going to trigger that. Although it was interesting that the Fed's forecast for the employment numbers are for a move up to 4.4, which was my projection. I also have been talking a lot about this bounce in inflation as well. And I wish I had time. I won't do it tonight because it would take too much of our time. But this chart here is the consumer price index. And I keep threatening this. I'm going to do a video that I think is really interesting because in 1970 is when everything went to the next level. And there's three different levels as we went through the years, different elements that came in, going back to 87 crash, to dot-com. Each one of these elements, they've just continued to inflate the economy. And this forecast is suggesting that we're going to round off, but this is like up in 2032. Okay, just if you look at the scale below it, it's pretty monster. But I put this chart, I'm going to be putting something together for this chart. So let's go ahead and let me just reduce this. Let's get back to the live charts here. So that's the big question, is if the numbers aren't real, at what stage do we actually adjust to reality? But The question is, what is reality? And we don't know what reality is. And reality is what the markets, there's an old saying that the markets are always right. So you got to look at pricing and that pricing mechanism. We just have to stay very vigilant and watching for anything that's going to trigger reality. Okay. What is there going to be some? I mean, that was pretty earth shocking with the adjustment with the BLS review. The previous year, they were off by 134,000. This year, 818. Interesting that that happened. I'm surprised that they even admitted to that it was that big. There were estimates, people were talking about 1 million jobs or more. Well, that was a lot. So and this has been my argument, when the market participants start to not react to these numbers, then we'll know that reality is setting in, and we're not gonna know what's going on. Yeah, and I wouldn't be surprised, like Kroger and all those folks are the big grocers and all those guys or something. Man, I wish I had an image. I want you folks, speaking of Kroger, speaking of grocers, and I absolutely, yeah, I hate Sprouts, okay? they're like, but here's what I want to tell you. Next time you go to the produce section and you see all that mist coming down, you got some Bill Gates stuff coming at you. That spray has chlorine and some other chemicals. If you look underneath the cabinet, you'll see the yellow warning sign that says that there's poison. I need to get this website. I've actually taken pictures of this on my phone, but they're spraying poison on the food, so wash the hell out of it. Hope you get everything off and it hasn't penetrated all the vegetables. But crazy stuff going on, and it's all about money because it's about preserving everything on. I think Bill Gates has got something, appeal, I think they call it, which is some coating they're putting on apples. It's all about making money, and yeah, a lot of poison. Anyway, I've gotten on this big health kick lately. So anyway, yeah, triple witching probably is already probably rolled out for the most part. Um, it's it's pretty good to. Yeah, it would suck to be a kid today. I agree. I have good news. My grandkids are at least in their mid-20s, so I don't have any small people uh, family in my life. But so let's go into yeah, the organic stuff's being sprayed. By the way, Joshua, that's the stuff they're getting. The organic air quotes. Um, yeah. Yeah, so farmers markets, try to get to know your farmer if you have the local markets till they shut that down. Yeah. So anyway, let's just go here. But rates are likely to come up to this 40 period uh, back on track here. I'm just looking here, 385, maybe 390 plus on yields coming at us. You can see the algos are all trending to the upside or forecasting the trending. Doesn't mean that the probabilities are stacked that way. And I think that's going to be the case. But like I said, it has to do, this is a hard concept for a lot of people because the normalization of the financial system that we're looking at it takes years to do it. It's taken them 2 years just to get everything. So we've seen the back end of the curve come down. We've seen all this happen very methodically, right? So we saw a little spike up to 4.5, and then boom, we came all the way down to 350, and now you're starting to see it come back up. So all of the front end's going to start to move, and it's another year out, folks. It's going to take like 3 years, and at that stage, I'm going to argue that the Fed is going to be out of the business of playing this game. And it's funny. I saw a friend of mine, won't mention a name, on his Twitter talking about how the market participants make rates, not the Fed. That's the way it's always worked. That's what I've been arguing with you folks, is that's why you see the back end of the curve has been the free floating part of the curve. And now that you see demand, you see real estate flattening out. I think real estate is going to make a little bounce here just because of some of the lower yields that we've already seen some of that. But so you'll see demand come back in a little bit on the back end, and then the front end of the curve will be no longer artificially adjusted out to be back in that, in that inverted yield curve to a normal yield curve, which will be a steepening where the front end is lower than the back end. And I'm still arguing it goes flat and then it just kind of tilts up over time. So we'll see how that unfolds from that standpoint. What do we got left here? I'm going to go to the Dow. I think we need to take a look at the Dow for a minute. Getting some pretty good volatility, but the forecast here, these red dots, I know, I just want to show you on, if you've got the WaveTech indicators, then you can go, then what you want to do is you just want to take any of the WTI forecast, doesn't matter which one, change the period of SMA to 1. I just made the boxes bigger so they made big red dots, and I keep all the other settings the same. And what it's doing is it's forecasting out into the future what this is likely to look like. What we're going to have to see over the next couple of days on the Dow is some stabilization here. I want to see the market grid, this outside line, which is the extreme. I want to see it turn back up, start to set up an upward channel here. And then when we go to the weekly chart, you'll see, I think we're pretty much at extreme. Somebody in last night's stream said this is the lowest level we've been for whatever. Typically, when you get there, we're right to the 200-day moving average, which is stable and rising in here. So we're going to see probably some stabilization along this 200. The weekly is suggesting that we're going to maybe dip under it a little bit more. We'll see what happens. But what you're seeing on the daily is this little blip. So when you start to normalize what you're looking at on a short-term chart and you go to different time series or you go longer like weekly, then you'll see a little blip on the front end, then it's showing some retracement. But I think this will normalize around the 200 period moving average, and the Dow is probably at the worst that it's going to be. Could go a bit lower. And while I'm bringing this up, let's just do a Dow or yen. This is a similar, you can see the Dow looks like it's going to strengthen against the yen. I think folks kind of lost track. If we got to a 130 yen, that would be really good for the Japanese, in my opinion. And especially with the rates have come down so much, their portfolio has done better because they own a lot of U.S. Treasuries, like I think still the largest position. And so that's kind of the case. And it's interesting, Lynn, that's what I've been talking about, is growing our own produce. That is probably the way to do it, for sure. So let's see here. Yeah, so here's someone's talking about Aussie dollar versus the dollar. So it looks like looks like it's going to move up. It's probably going to top out here, around 69 cents. Some of you may not know, but I used to live in Melbourne, Australia back in 1980. It was $1.15 versus the dollar then. So you lost money coming down there. So anyway, but it looks like we're probably coming up towards this 200-day. Algos are all short-term bullish, but then more downside there. Yeah, Natalia, I would love that, by the way. Yeah, just look here. Yeah, it was very interesting, Joshua. 1980. There used to be, and I don't know. I do have some friends down there yet. I have a good friend that since I met when I was down there. But there used to be strike season, and as Americans, my wife was like, they were shutting down. They were telling us they were going to shut down the power because the power workers went out. Then the truckies went out. There was no food at the stores. Safeway was the biggest chain down there in 1980 at the time. So they just gutted everything. Then the postal workers went out. And then the postal workers got a better deal than the truckies, and they went back out. And so it was really interesting. I think we went through like 4 months of strikes. Uh, it was an interesting space and time back in those days. Anyway, but I think the Dower is going overall, just going back to the Dower will stabilize there. Let's take a quick look at gold. I'm just going to run through a bunch of stuff here while we're together. It's the end of the week. Gold got an RTX sell signal. This is a weekly, so we should start to go more sideways. I suspect, if not this coming week, it looks like things are going to try to roll back in and go into sideways range. But we've just been inching higher on gold, and we printed up what 26, 27 last. So this week has been a new high, currently 20, 26.10. So we're continuing to see this, but I think we're going to flatten out. No big downside here at all. If anything, we get consolidation. And I think I showed it the other night. Let me just bring it up, see if I can get it to pop for us. Yeah, this is the forecast for gold on a monthly basis. And we're just, we're seeing, 20, this, by the way, is into February 26th. But if we just come in, we're looking at higher prices, at least in the 27.50, 28.50 on the upside. And, is that going to be because of lower yields? Possibly. That definitely will drive the markets, at least from the standpoint of that. Yeah, I'm just looking at a couple of comments here from you folks. Yeah. Oh, okay. I used to live in Camberwell, Richard. Yeah. So that was way back in the day, just to ride the trolley out that way. So anyway, um, I enjoyed my stay, with the exception of driving on the wrong side of the road. Anyway, but this gold looks like fairly bullish going forward, and I would, any of the moves down into these moving averages weekly, those are opportunities to add. They're not going to give you much on the downside for a while. Things are just too crazy going on, and yeah. Yeah, so Joshua, I used to run a hedging desk for metal companies. We did primarily gold and silver. And this is an interesting thing. Yeah, maybe you folks have noticed that when gold mining stocks don't perform very well, even though gold is going up, and they always seem to lag. And this was our experience. This was 1990, 90, 91, 92 when I was running. I had a unit that I ran, which was all we worked with was gold producers and users. But for the most part, the producers, the mining companies that we worked with, none of them took in. They would forward sell all their gold up 1 year, 2 years. They would forward sell everything. I remember there was a very bullish period at the time that there was an opportunity to be long gold. And we're like, no, don't sell everything. keep 20, 30%, sell forward a bunch of this stuff. But this is why mining companies are really just taking margins on their production, and they just lock it in. They don't. You would think of all people in the world that would want to play the gold market from a bullish standpoint, it would be them. But a lot of these businesses, whether it's banks and mining companies, they're in the business to sell product and make margins and all that. They're not speculators. It seems odd that they wouldn't be that way, but I've seen that a lot from the but just from experience. I mean, it's interesting. I've had the opportunity to work with banks, mining companies. Those are the two big hedging operations that we had that I worked directly, and I ran those units. And I ran the third largest unit in the largest commodity trading company on the planet. So we had pretty good influence, especially on stuff. And I was talking yesterday in a live stream that even worked with. I was talking about I voted for Jimmy Carter, and my first vote, I think when I was 18 years old, was in college, so it seemed to be the right thing to do. But I actually worked with Jack Carter at a company which we were on the bank hedging side, and Jack worked for a unit that was a subsidiary of the company that I worked for. So anyway, but I've had the experience of seeing these things, and it just fascinates me. I'm like, why do these gold mining stocks always lag? They're terrible. And then I go, oh yeah, I remember this was 1990, 30 years ago, that these guys always forward sold everything. They didn't speculate. So anyway. Okay, where are we at here? Let's do Bitcoin. By the way, I'm gonna, if you don't get the Substack, get it. It's $8 a month. I lowered the price back, and we'll get it. You can sign up for a full year. I think it's like $6.50 a month, and I enjoy writing it. I'm up usually for the London Open every night, so this is a late night for me. I've got the monthly chart up here on Bitcoin, so let's take a look. And this is one of the if we look at this thing from a longer term viewpoint, what we'll see here is that we're getting somewhat of a distribution top. If we can take out this high of last month, which is 65.4, I'll show you in a minute. We actually have some fib targets here on a monthly basis. We've got 71,000. Let me get exact number: 71,312, 80,640. That's where these green dots are up here. But let's scale it back a little bit, and let's go to the weekly. This is a crazy pattern. I've been talking about getting up to 64,000 level. We've basically done that. 63,000 is the weekly. 820, we're at 63,081. The R3 for the week is 64,386, and then we got 66,000. But we also have three fib targets over here. If you look on the far left, 66,043, 72,300, and 76,210. So these are, but here's the thing: we're not getting confirmation of any big moves, so we're probably going to stall right in here. And I'm going to bring up the daily, and like I said, I'll cover this in the Substack later tonight. So we're coming right up on the 200. It actually looks like we touched it. Let's take a look at here. Yeah, so the 200 was 63,980. The high was 63,882. So right on it. That's right where the resistance. We're still upward slope. We still have two Fibonacci targets on a daily even, which are suggesting that we could go to 64.9, 67,000. We'll just round that number off. Okay, folks, that'll probably do it for tonight. We got through quite a bit of market, so I appreciate that. Yeah, so somebody's asked me, how did I learn to trade? Um, I had some pretty good mentors, but basically, the School of Hard Knocks. I had somewhat of an advantage, and in the early days, I was a broker, and I always traded my own money. So uh, at one stage when I got successful enough, I always told clients, which was true, that I put on every trade that my clients put on that I suggested. So I had to put the trade on last. There's a thing on a regulatory standpoint that you have to be the last one in. You can't buy and then put all your customers in and front run your book. So you have to always make sure the timestamps that everybody that you solicited a trade on that you had to go on. But really, it was just a, I guess a trial and error, studying the hell out of the markets. You know, we did some crazy studying. People didn't have questioned that from roughly 1983, probably into 87. I'm going to guess we got like 3 to 4,000 hours of study in. I had an associate that we worked together, Wave Tech, a lot of concepts, the indicators that I have on the screen here. Those are all built back in 1984. So this was, and I'm actually, it's interesting that you bring that up. I'm working on writing like a little mini book about my path and some of the techniques that I use. So started working on some of this stuff today. I've got a bunch of work that I've got out there that I've done. If you're on the Substack, I think I made these publications. There's some articles I wrote on the PPMs. There's some other stuff. Um, yeah, so how did I handle Black Monday? Believe it or not, we were short on Wednesday ahead of Black Monday, and we had put spreads on, short calls, and short futures. And I should get a picture, but after that, this is 1987, I bought a 1987 turbo black Porsche. My sales assistants used to call it the Batmobile. And I had the old phone that was attached to your car, your cell phone that was in the car. But that was my gift to myself for trading. And that was a huge opportunity. The only issue that we did is we made so much money by Friday on option expiration that we took all the trades off. So on Monday, on the biggest down day, I was sitting there looking at the screen, sick to my stomach. So yeah, so I'm working on this thing. I've got a lot of stuff that we're working on in the background. So um, anyway, yeah, I appreciate everybody watching. You know, we got 225. That's pretty good for 10 o'clock at night. I know some of you are, um, it's almost 11. So anyway, yeah, Black Monday Porsche. I had pictures of me with the car. It was pretty cool. Yeah. So I've been fortunate enough to have some cool cars. But anyway, yeah, yeah. There's so much stuff. I have a friend that's trying to get me to do some sort of podcast or something and bring in a bunch of old buddies, those of us that are still alive, and tell a lot of stories and stuff. Um, no, Chi-Town, I don't have any new indicators. I did figure out something that I'm working on right now that's really cool. I didn't realize it until, um, yeah, I didn't realize it last night that I could do this, but I will share with you once I've tested it a little bit, but I think it's going to be super cool idea or something I came up with that will be really amazing. Anyway, Appreciate it. North Carolina, love it. I don't think, Tony, there's not really any new indicators, but I think some new techniques that are working on. I still am trying the hardest to get the models into TradingView. TradingView is got a lot of data. It's cool platform, but it's very limited in what you can do in code. It's actually old school. It's not very sophisticated. There's some things you can do that are really cool, but there's other stuff. And one of the things that we did with our models, even in TradeStation, is we had to write a module outside of TradeStation we have an executable model that runs outside of TradeStation, and we can submit data and pass it back and forth between it. So even there, we had to do some things that were a little different. So. Yeah, just looking here. Anyway, yeah, folks, thanks for watching. It's the end of the week. Like I said, 4 videos. I'm going to do my best to. Yeah, Joshua, that's exactly what, I've got some old floor buddies. We got a bunch of folks that we can just sit around and crazy stories, things that happened in trading pits, trades that went on. It would be fun. I've got a very famous trade that happened in 1992 that was very interesting, and I picked it up from basically from a Goldman trader that kept putting this trade on, and we figured out what they were doing, and we kind of front ran them and stole a bunch of money from Goldman. It was fun. Anyway, folks, have a great evening, great weekend. Read the Substack later tonight. Everything would be, yeah, I think it would be fun. I'd like to do that. I've been threatening it. I've actually got a group of guys that we've been talking about meeting in Vegas and getting cameras, like really high-end cameras, and just put the cameras in and edit it down. So anyway, it would be really fun to do. Anyway, hey Ed, good to see you. Anyway, talk to you folks soon, and I appreciate everybody coming. All right, folks, have a good evening.